All right, so get this. We're going deep into investing today. We've got a ton of great resources to help us out. Bankrate's 6 best investments for beginners, Money Helpers, a beginner's guide to investing. Oh, and Morgan Stanley's Investing 101, NerdWallet's Investing 101, and Millennial Money's How to Confidently Start Investing.
Wow, that's quite the lineup.
Right. So our mission basically is to get a handle on, investing basics, figure out where to start, what options are out there, all that good stuff.
It sounds good. We'll be going way beyond just, basic definitions, though.
Oh, yeah, definitely.
We're talking about why investing even matters in the first place. Like, we'll break down those different asset classes, the ones everyone throws around but no one really explains. And yeah, we'll even tackle that age-old question. Can you really beat the market?
What's really interesting to me? Millennial Money's saying that only 10% of professional investors actually beat the market. If the pros are having a hard time, where does that leave the rest of us?
That's a really good question, and it shows why understanding the fundamentals is so important,
Yeah.
But before we dive into the specifics, let's take a step back for a second. Every single source we're looking at stresses this one point.
Yeah.
Investing is crucial if you want to beat inflation and grow your wealth over time.
Makes sense. I've heard all those inflation warnings, but honestly, sometimes it feels kind of abstract,
Sure.
Can you give me like a real world example?
I think NerdWallet actually explains this really well. Imagine you have a $100 bill that you've, tucked away.
Okay.
Because of inflation. Next year, it might only buy you like $97 worth of groceries.
Yeah.
Basically, your money's slowly losing value if it's just sitting there.
Okay. Yeah. That makes inflation way less abstract and a lot more like something I need to fight against.
Exactly.
So how does investing help us do that?
Historically, the stock market has averaged an annual return of about 10%. NerdWallet points this out. That's a lot higher than what you'd get in a regular savings account. Over time, that difference in return can really add up.
I got it. But before I go throwing all my money into the market, Millennial Money talks about getting your financial ducks in a row first.
Right.
What are those ducks exactly, and why are they so important before I even think about investing?
Basically, it comes down to 2 main things.
Okay.
First, you've got to tackle any high-interest debt, things like credit cards. That debt grows faster than your potential investment returns, so it needs to be a priority.
Okay. Yeah, that makes sense.
Second, you need to build a solid emergency fund. Most experts recommend having 3 to 6 months of living expenses in an account that you can access easily. This acts as a safety net, so you don't have to touch your investments if something unexpected happens.
Got it. So no high interest debt and a safety net in place. Check and check. But what if I'm not exactly, rich? Can I still start investing?
Definitely. All our sources make this clear. Millennial Money says it best. Invest it is.
It takes the pressure off, feeling like I need a ton of money just to get started.
Exactly. Now, before we get lost in all the different investment options, let's talk about the basics.
Okay.
Asset classes. Morgan Stanley and Money Helper both have really good overviews on this.
Okay, this is usually where I start to zone out. I've heard these terms, but can we break down what asset classes actually are?
Think of them as categories of investments with similar characteristics and that behave similarly in the market. It's kind of like grouping animals together in a zoo. You're recognizing their shared traits.
So it's like organizing the investment world into different habitats?
Yeah, exactly.
What are some examples of those habitats?
There are 4 main asset classes. Cash and cash equivalents, bonds, equities, which are also known as stocks, and alternatives.
Let's start with cash and cash equivalents.
Sure.
Those sound pretty straightforward.
They are. Think of things like savings accounts, certificates of deposit, or CDs, and money market accounts. These are generally considered low risk. You're not likely to lose your principal.
Right.
But they also tend to have lower returns compared to other asset classes.
So good for short-term needs or for your emergency fund, but not the best for building long-term wealth.
Yeah, exactly.
Okay. What about bonds?
Bonds are essentially loans that you make to companies or governments.
Okay.
You lend them money, and they promise to pay you back with interest.
So instead of me hoarding cash under my mattress, I'm lending it out and getting paid for it.
Yeah, basically.
But how do bonds compare to cash in terms of risk?
They're a bit riskier than cash, but less risky than stocks. One key thing to remember about bonds is that they're sensitive to interest rate changes. If interest rates go up, the value of existing bonds usually goes down, and vice versa.
So it's not just about the interest payments, the value of the bond itself can actually change too.
Exactly.
All right, got it.
Yeah.
Now let's talk about the exciting ones, stocks.
Yeah. So when you buy a stock, you're buying a small ownership stake in a company.
Okay.
They have the highest potential for returns, but also the most volatility.
So higher risk, higher reward.
Exactly.
All right. And lastly, we have alternatives.
Yeah, alternatives are kind of a mixed bag. This category includes investments like real estate, private equity, and commodities.
Alternatives, they always sounded kind of mysterious to me. What's the point of adding those to a portfolio?
They can be great for diversifying your portfolio even more, but they often come with higher risks and might not be a good fit for every investor, especially beginners.
So we've got our four main asset classes. What do we actually do with this information? How does it help us build a portfolio?
That's where asset allocation comes in. Money Helper highlights this in their guide. It's basically how you divide your investment money across those different asset classes.
Okay.
How you allocate will depend on your goals, your time horizon, and your risk tolerance. A younger investor might put a bigger chunk into stocks for growth, but someone closer to retirement might choose a more conservative approach with more bonds.
So there's no one right way to do it. It's all about finding the right mix for you.
Exactly. Now that we have a basic understanding of asset classes, let's move on to the fun part.
Yes.
What are some of the actual investment options out there?
Yes. Let's get into the specifics. Where do we even begin? It feels like there are endless options.
Back again for more of The Deep Dive.
We're continuing our exploration of investing for beginners, and I think this part is something a lot of people struggle with.
Probably right. So many options out there. The financial news is constant. It's easy to get overwhelmed. But remember, investing doesn't have to be complicated.
That's good to hear. So where do we even start? What are the first steps someone can take to make sense of all of this without getting totally lost?
NerdWallet has some really good advice here. They suggest starting with a little self-assessment even before you think about specific investments. Ask yourself some key questions, just to kind of define your personal approach.
Like, what kind of questions are we talking about?
Well, one crucial question is, what are my financial goals? Are you saving for a down payment on a house, planning for retirement, maybe dreaming of that big vacation? Each goal needs a different approach.
Makes sense. A short-term goal, like a house down payment, probably needs a different investment strategy than something, way in the future, like retirement.
Exactly. Another important question is, what's my time horizon? How long do you plan to invest this money before you need it? This ties into your risk tolerance too.
Right, because if I need the money in a few years, I probably can't take as much risk as someone who's investing for decades.
Exactly. And maybe the most important question, which we already talked about a little bit, is what's my risk tolerance?
Yeah.
How comfortable are you with the possibility of your investments losing value in the short term?
This is where I get a little nervous. Nobody likes seeing their money go down, even temporarily.
I totally get that. But acknowledging your risk tolerance is super important for making good decisions and avoiding emotional reactions to market changes. Once you've thought about those questions, you'll have a clearer picture of your investment style. NerdWallet suggests putting yourself in one of three categories: conservative, moderate, or aggressive investor.
Okay, so that gives us some helpful labels to work with. What would those different investor profiles actually look like? What kind of choices would they make?
A conservative investor, they usually prioritize safety and keeping their principles safe above everything else. They might choose investments like bonds, CDs, or high-yield savings accounts, things that offer lower returns but aren't likely to fluctuate in value a lot.
So it's all about minimizing risk, even if it means accepting a slower rate of return.
Right. Now, a moderate investor, they're willing to take on a little more risk to potentially get higher returns. They might include a mix of stocks and bonds in their portfolio, trying to balance growth and stability.
So they're trying to find that middle ground. Not too risky, but also not missing out on potential growth.
Exactly. And then we have the aggressive investor. They're more comfortable with volatility and are looking for the highest possible returns. They might put a larger portion of their portfolio into stocks, maybe even growth stocks, or more speculative investments.
So they're okay with the market going up and down, hoping that those big swings will mean bigger gains over time.
Exactly. Of course, these are just broad categories, and most people fall somewhere in between. The important thing is to find what feels right for you based on your own situation and comfort level.
This is helpful for those initial decisions, but once I kind of know my risk tolerance and investment style, how do I actually choose specific investments? That feels like the hardest part.
That's definitely where the action happens. Luckily, there are tons of resources and tools to help us. We've already talked about robo-advisors, which are great for hands-off investors. They make things a lot simpler by creating and managing a diversified portfolio based on your preferences.
So it's like having an automated investment manager working for you behind the scenes, setting everything up based on my goals and risk tolerance.
Exactly. You tell them what you want, and the robo-advisor's algorithm takes care of the rest, building and rebalancing your portfolio whenever it needs to. But what if you want more control over your investments? Like, what if you want to actually choose specific stocks or funds yourself?
That's where I think a lot of people feel intimidated. It feels like you need to be a financial expert to make those decisions.
I see your point, but that's also where online brokerages come in. They let you buy and sell a wide range of investments, stocks, bonds, mutual funds, ETFs, all on your own.
So I have the freedom to choose whatever I want, but I'm also responsible for doing my own research and making good decisions. It sounds empowering, but also a bit scary.
That's true. But it's important to know that online brokerages often offer a lot of support too. A lot of them provide educational resources, research tools, even access to financial advisors. You're not completely alone.
That's a relief. It's good to know there are resources to help you figure things out, even if you're not a financial expert.
Definitely. You can find tons of guidance to help you make smart choices. And if you need more personalized help, you can always talk to a financial advisor directly.
That brings up another question. When does it make sense to actually hire a financial advisor? Is that something everyone needs, or are there specific times when it's especially helpful?
That's a great question, and the answer depends on your personal situation. Hiring a financial advisor can be really helpful for a lot of reasons. Like if you have a complex financial situation, maybe you have significant assets, multiple sources of income, or complicated taxes, an advisor can give you specific guidance and help you make a comprehensive financial plan.
So they're not just about choosing stocks, but about helping you see the big picture and making sure everything in your financial life is working together.
Exactly. They can also give you valuable advice on more specialized topics, like retirement planning, estate planning, and making sure you're paying the right amount of taxes. It's really about having someone you trust to help you navigate those more complicated financial decisions.
I can see how that would be so helpful for someone who feels overwhelmed by all those different parts of their finances. But how do you find a good financial advisor? There are so many out there, it's hard to know who to trust.
You're right. It's really important to do your research and find an advisor who's a good fit for your specific needs and what you believe in. Start by asking friends, family, or colleagues for referrals. Word-of-mouth recommendations can be really valuable.
That's always a good place to start. But what if you're totally starting from scratch and don't have those personal connections to rely on?
You can also look at online directories, like the one the Certified Financial Planner Board of Standards has. This can help you find qualified professionals near you. And when you're talking to potential advisors, don't be afraid to ask tough questions about their fees, their experience, and their investment philosophy.
Right, because you're basically trusting them with your financial future. It's important to feel comfortable with how they do things and make sure their values match yours.
Exactly. And remember, you don't have to work with the first advisor you meet. Take your time, find someone who really gets your goals and helps you feel confident about your financial decisions.
That's really good advice. It makes it a lot less intimidating knowing there are ways to find the right support. But there's another thing a lot of beginners worry about. What if I don't have a lot of money to invest? Should I wait until I have more saved up?
That's a really common thought, and it stops people from getting started unnecessarily. All of our sources, especially Millennial Money, make it clear. You don't need to be wealthy to start investing. Remember, time is your most valuable asset. The sooner you start, even with small amounts, the more time your investments have to grow.
I love that. It takes the pressure off feeling like I need a huge amount of money before I can even try. Starting small feels much more doable.
Exactly. Consistency is key. Even small contributions can add up over time, thanks to compound interest. It's something every investor needs to understand, no matter how much they start with.
Okay, compound interest, I hear that all the time. But can you explain how it works? What makes it so powerful?
Imagine a snowball rolling down a hill. It starts small, but as it rolls, it picks up more snow, getting bigger and bigger. That's kind of like compound interest. You're essentially earning interest on your interest. As you keep reinvesting your earnings, your money grows faster and faster.
So it's not just about earning interest on my initial investment, but on all the accumulated interest I've earned along the way. That makes sense, but it's still mind-blowing.
It is. Over time, This snowball effect can really add up, even if you start with relatively small contributions. That's why starting early, even if you can only invest a little each month, is so much better than waiting until you have a big lump sum.
So even if it's a tiny snowball at first, as long as you keep it rolling, it has the potential to become something much bigger later on.
Exactly. And that brings us back to a really important point. Investing isn't just for rich people. It's a way to build financial security and reach your goals, no matter how much you have to start with.
Yeah.
But it all starts with taking that first step.
We've talked about a lot in this section: risk tolerance, choosing investments, and starting early, even with small amounts. But before we move on, I want to leave our listeners with a question to think about as we go into the final part of our deep dive.
Okay, I'm curious. What is it?
What if you're someone who has always avoided investing because you think it's boring or intimidating or maybe even a little, I don't know, distasteful? How can you change your thinking and start to see investing as an exciting opportunity instead of a chore?
That's an excellent question, and it's something we'll definitely address in the last part of our deep dive. We'll look at how to make investing engaging, even fun, so you can actually enjoy building your financial future. Stay tuned.
We're back for the final part of the deep dive. In this last part, we're tackling a question that I think some of you might be wondering. How do you make investing feel less like a chore and more like, an exciting way to reach your financial goals?
It comes up a lot, and for good reason. The world of finance can seem really dry and intimidating, especially when you're just starting out.
Totally. Numbers on a spreadsheet aren't exactly known for being, thrilling. But our sources actually have some good ideas on how to make investing more fun and engaging.
Millennial Money had a really interesting idea: changing your perspective. Instead of seeing investing as this purely technical thing, what if you thought of it as a way to support companies and causes that you believe in?
Oh, that's a cool way to think about it. So it's not just about making as much money as possible. It's about investing in things that align with your values.
Yeah, exactly. Let's say you're really into sustainable living. You could look into investing in companies that are committed to environmental and social responsibility. You're basically putting your money where your heart is, which can make the whole process a lot more meaningful.
I love that. It takes investing from feeling like this cold, calculated game to something that feels more personal and impactful. What are some other ways to make investing less scary?
NerdWallet really emphasizes starting small and learning as you go. You don't have to jump in all at once.
So it's more like dipping your toes in the water and getting used to it gradually.
Exactly. Start with a small amount that you feel good about investing and slowly increase it as you get more comfortable. And don't forget, there are tons of resources out there to help you learn. Ask questions, read books, take online courses, whatever works for you.
It's about feeling empowered as you learn, not overwhelmed. But what about people who don't really enjoy tracking numbers or obsessing over the market? Is there a way to make investing more hands-off?
Definitely. We've talked about robo-advisors, which are great for people who want a more automated approach. They take care of the day-to-day management of your investments based on your goals and risk tolerance.
So you're basically letting an algorithm handle the decisions, and it's designed to work toward your goals.
Yep. Robo-advisors free up your time and energy so you can focus on other things. But what if you're the kind of person who actually likes researching companies and picking individual stocks?
That sounds more like me. How can we make that research process more fun?
NerdWallet has a cool idea. Turn it into a game.
A game! Okay, now I'm interested. How do you turn investing into a game?
It could be as simple as setting a challenge for yourself. Maybe you try to do better than a certain market index or aim for a certain percentage return.
So you're adding a bit of friendly competition, which could make it more engaging and motivating.
Exactly. It's a fun way to learn. And it might even make those market dips a little easier to handle. You start seeing the ups and downs as part of the game instead of taking them personally.
I get it. A little competition can make things more exciting. So there are lots of different ways to approach investing, from using a robo-advisor to picking your own stocks. The main thing is that it doesn't have to be boring or scary.
Right. You can find a way that fits your personality, interests, and values. And once you do, investing becomes less about a chore and more about taking control and building the future you want.
All right, as we wrap up this deep dive, I want to leave everyone with a final thought. Now that you know about all the possibilities of investing, what's one small step you can take today to get started? Even if it's just doing some more research or checking out a robo-advisor platform.
It's all about taking that first step. Remember, investing is a journey, not a destination.
We hope this deep dive has given you the knowledge and inspiration to start your own investing adventure.
Thanks for joining us on the deep dive. Happy investing.